So some people might find that as a big win because they might not need 4% of $1 million being drawn down. This was actually brought about during the COVID, to help people during COVID. If you have a self-managed super fund, or you have a super fund, there's a minimum amount. If you're on a pension phase in your super fund, there's a minimum amount that you need to take out each year. Why is that a bad thing, so to speak? Is that if you take money out of super, usually it's really hard to get it back into super for people who are retired. So you actually want to take it out as slowly as possible, if you can. At least the compulsory amount should be as little as possible, so that you have more freedom in how much you keep in super. What they've said here is that they've reduced. So this is the old rule, the one that was introduced about 2 years ago. They're saying that the minimum requirement for the pension drawdown is reduced, and what they're saying here, we're going to extend that rule essentially, so you don't have to draw down. It was at 50% more than the usual, so it's reduced by 50%. So yeah, that's going to extend all the way to 30th of June 2023. And yeah, there's some rules there. Obviously, minimum drawdowns depend on your age. Usually it's around 4%. Now they're saying, hey, look, you don't have to draw 4%. You can draw down 2%, keep more of your money in super. That gives you a bit of flexibility, rather than having to draw 4% out of super as well. So some people might find that as a big win because they might not need 4% of $1 million being drawn down. They might only need 2% to live on. They want to leave more of it in super, because it's a great tax environment in there for them.